little bit about the next two presenters. So Patsy Hewitt is a partner and business advisor with M&P's Assurance and Accounting Group in Brandon, Neepawa, and Minnedosa. She is the Regional Agricultural Risk Management Resources Leader for Southern Manitoba and a member of M&P's National AR/MR team. Patsy earned her diploma in accounting from Palliser Business Institute in 1997. She is a chartered professional accountant, qualifying as a certified management accountant in 2004. And then for Peter, so Peter is a business advisor in MNP's Farm Management Consulting Group. He has over 20 years of industry experience. He has first-hand knowledge of agricultural production. He understands the challenges the agriculture sector faces in today's age and can quickly identify opportunities as well as some of the risks facing producers. Peter was designated a professional agrologist in 2004 after completing a Bachelor of Science in Agribusiness at the University of Manitoba. So I'll ask you all to give them a warm round of applause and welcome to the stage.
Thank you very much. I was going to make a joke about nuts, but I don't think that's appropriate after the previous.
We said you weren't going to do that, I think. Thanks very much, everybody, for coming out this afternoon. Peter and I are just going to go right into the presentation. So if you have questions as we go along, throw up your hand and we will try and answer it, or we can chat after the presentation.
There is also up at the back, I think on the table, and there's a display, there's a QR code that you can scan with your phones if you've got questions, if you'd like some follow-up, either from us or some other another professional at MNP, then you can certainly do that and we'll make sure that someone follows up with you. So today we're going to talk a little more generally, not specific to the cattle business. I'm going to do some slides talking about the grain sector, but just talking about risk management, looking at some current market trends, really the importance of risk management planning. This is something that I don't know, feels like a little bit like flogging a dead horse, but I think that we all can agree that the market conditions have changed the last 2 years. Certainly on the grain side, I think on the cattle side, we're Brian's going to talk about this later about how profitability maybe at the top of that, the top of the curve, but still an opportunity to think about your planning for the future. Really about the importance, and then talking about some building resiliency and some high priority tasks, which is actually where I'm going to start and where we're going to end. So for some of the presentations that I've done this winter, really focused on building some resiliency and success in 2025 and 2026. We're not obviously going to talk about all of these things today, but these are some of the things that we've identified as being important for things to be working on your farm business. Today we're going to talk about risk management, but that's really part of some overall maximizing those high value management tasks. Secondly is devoting time to your people problem. You might think about this as labor, but what's the number one people problem that farms have? Anyone want to guess? Nobody brave enough?
I'm going to guess shortage of good people.
That's a good guess, Patsy, but the number one issue that all farms have in common, whether you have hired labor or not, is farm transition. And so important really to be devoting your time. There's been lots of discussion. I was at a seminar this morning about it. Patty Duran talked about it as well. So there's lots of people that are out there to help you with that. Thinking about some short-term investments to enhance your operation, and then looking at your debt structure and getting it right with the expectation that margins potentially on the grain side are going to be tighter, but the best time to get your debt structure right, even in the cattle business, is when your margins are good.
I think the interesting thing that you'll see as we do the presentation, and Peter went through, but as we talk about risk management, it's not just specific to your insurance programs or the government programs out there. A lot of those things are really what's going to help you navigate through the challenges every year.
So if we look at some of the trends that we've seen, this is kind of the last, since 2012, seeing some of the trends that we've seen in this is in eastern Manitoba, looking at grain gross margin versus the trend is, we're down in 2024, projecting our gross margin to come down from $406 an acre down to $304 which is a significant drop from where we were, kind of through that 21, 22, 23 time period. But if you look at the long-term trend line, which is that linear trend, is that we're really back in line with where we've been historically. In that $300 an acre range, our projections for 25 are very similar based on trend line yields. So obviously not back to where we were in the most immediate term, but kind of back in line with where we'd expect to be from a long-term perspective. The challenge, as you guys are well aware, is what we've seen on the cost side. So, significant increases in our production expenses, so seed, fertilizer, chemical expenses that we built into that gross margin number. But then also, a significant increase in our operating expenses. So, M&P, we call that land or labor power machinery. The cost of equipment, the cost of repairs, the cost of labor, all of those things continuing to go up. And then on the overhead expenses, interest costs that have gone up, we're maybe starting to see some of those wane, but the cost of land rent, the cost of ownership of land in terms of purchasing, just means that those costs are going to continue to increase. So what we've got then is this trend that, despite the fact that we're in line from a trend line from a gross margin perspective, is that our cost squeeze is causing farms, some of these projections that we've got, to be at break even or very close to break even. And so really just comes back to this importance of understanding how your risk management plan, how it lays into kind of your overall business decisions. So one of the things, so in regards to that, before we kind of talk about some of the programs and about risk management, is just a reminder that the best way for you to manage risk on your farm is to improve your profitability or improve your margin. So the more resilient you are, the better your margin is relative to other producers, means that you're going to be able to weather storms better than other people. And so despite the fact that there's some other programs that are out there, there are things that you can do to improve the margin of your farm. So obviously reducing costs, looking at budgeting, doing review of your costing, really having a good capital management plan. Another option is to look at increasing your land base, maybe spreading your costs out over more acres. The challenge with that is that there's a limit to the efficiency gains that you can get, and then that the risk that's associated if you're going to go ahead and add debt to your balance sheet, and that's a challenge as well. And then finally, really looking at ways that you can increase your gross margin. First of all would be looking at ways to get more out of the products that you have. So kind of a better or a more intensive marketing plan. Looking at some different farming practices to try and extract more value out of the land that you're farming, or look at increasing yield and changing crops. And again, coming back, some of you that are in here are beef farmers, that applies to you as well, not on the cattle side, but also on your land-based side. So looking at ways to increase the return that you're generating out of the land base that you had, whether that's more intensive pasture management, whether that's looking at growing some different crops that maybe are going to generate more biomass for you on a per acre basis. One of the challenges that we have with risk management, we talk about risk management planning with farmers, is that we don't know, that we're not necessarily asking the right questions. And so I wanted to give you an analogy. I recently purchased a new truck, or a new to me truck. It was used, and I went out looking for a vehicle. And so I immediately went out, was looking for something that was well equipped, safe, reliable, and efficient. So do you think that those are things that you would look for in a vehicle? Do you think those are good things? You would say yes, Patsy? So when I went looking for that, I found myself a Chevy Aveo. So this was not the car that I was looking for. It doesn't mean that it's not a good car, but it doesn't suit the needs that I had. And I think that we all can think of reasons, we're in winter here, why this might not be an appropriate car for my situation. So again, I went out and looked again for a well-equipped, safe, reliable, efficient vehicle, and I ended up with this. Now this is a little bit closer to what I was looking for, but still not, if you're maybe hauling around livestock or you're looking for something different, it might not fit the needs that you have. And finally, which is a little closer to what I ended up purchasing, is this well-equipped, safe, reliable, efficient vehicle. So we asked what seemed to be good questions, or I asked good questions in looking for this new vehicle that I had, but I wasn't asking the right questions, or enough of the right questions to get to hone in specifically on what's going to work for the use that I have. And so when we look at risk management options, is that we can get very easily overwhelmed with all of the choices that are out there. So we work a lot with agri-stability specifically with our firm and our clients, and it has certainly has a lot of pros to it, but there's some things that don't maybe work well or aren't as good. Obviously, crop insurance is a product that a lot of people know, but again, it doesn't kind of necessarily fill all of the needs in. There's some private insurance on the grain side. GARS, Global Agri Solutions, are a relatively new product out there called AGI3 that, again, have some of the solutions that maybe fit some of the problems, but we're just not really sure. They don't kind of work well all on their own. And then finally, even on the livestock side, we have the Western Livestock Price Insurance Program. Again, it's an option, but again, how does that kind of fit together with the other programs? And if we look at them all individually, then it doesn't really give us the solution that we're looking for, and we end up with kind of one of two things. We either end with blind spots where the risk management plan doesn't work, or it doesn't cover you for the risk that you thought it did, or where you've actually overlapped and you're paying twice for something that isn't going to provide you the extra coverage that you're looking for.
I think that's probably one of the things, that we see that we really like to talk with producers about, is just that, because sometimes you can get insurance and have the mindset, the more I get, the more I'm protected, but actually there's a different way of looking at it with sometimes they can work against each other too. So it's really understanding how they come together and then what works best for the farm. So I always like that graph when Peter puts it up, because I think you said it at the beginning, it can feel like it's quite a lot of information, and what do you do with it? So
I forgot that part.
Go ahead.
The other thing that I think we talk specifically about is business risk management plans, that we forget that there's other things and other tools that are out there that maybe we wouldn't think specifically as being specifically tied to risk management, but there are other tools in the toolbox to help to manage an overall plan. And two of those things that are, again, government programs, one being Agri-Invest, and then the second is being the APP, or the cash advance program. So again, tools that are in the toolbox that kind of create this overlay with an overall risk management plan.
Yeah, and when we've been in this higher interest rate environment, those cash advances can really make sense, because if we can get this year $250,000 interest-free compared to, say, 6% on your operating line, that's a bit more money you can put into the farm. So when we talk about risk management, we often talk about MNP's approach, and a lot of it is really going through what Peter just talked about, looking at all those things on the farm. Some really key things are understanding your cost of production. So you need to know what outlays you've put out there that you need to cover. We can look at, we just showed that graph, but the different business risk management programs that are out there, how they work together, work against each other, and how they work best for your business. And then we can complete, and Peter will go through it near the end of our presentation, but what if analysis. So I have a few clients that we'll do this with, where we can put their current risk management plan into the actual software and run some scenarios. So what if this happens, Patsy, or what if this happens, what is my coverage? And so that helps you to see kind of those spaces there where maybe we're not covered as much as we are, or maybe we're over covered. So we're not going to spend a bunch of time talking about it, but I do think it's important today that we spend a couple minutes talking about the agri-stability program. Perhaps more on the grain side this year. I know we'll have some cattle producers in here, but 2024 looks like a year where we are going to see some payments come out of that program, or more than we have. Peter went through the graph where we saw what those trends have been. So the last couple years we've had some really great grain prices and good margins. And so 2024 we can see we're coming down. Our costs aren't necessarily coming down, but prices are. And so that is one of the things with the program and how it works. So we just thought we'd take a couple minutes, walk through it, give you a couple things to just make sure you're talking about and asking as you go through and file that for 2024. So this is just a real quick summary of how the program works. It's a 5-year based program. The best year you have and the worst year are taken out, and then we average the 3. So this is where you can see with some of those better grain years, and cattle we've had a year or 2 good years, so we'll be building as well, but we're building those blue bars, and so now we'll have a higher amount where we can potentially, in a year like 24, trigger a payment. So in this scenario, we've got 5 years, taking off our best and our worst and averaging out the 3. We then look at the current year, so in this case 2024 we're talking about, and we know that it's going to look lower than it typically has in the last couple. So in this scenario we've got what we call the program year margin, so 2024, what kind of a year that was, and in this example we show we've got a loss. The way the program works is the first 30% of that loss is out of the producer's pocket. The remainder of the loss is split with the government now, 80% and 20%. Previously, the program was 70%, so they are trying to make the program better and give more income to our producers. On this graph here, I think this is an actual client, and so this really shows what I think is key to knowing in 2024. This shows that we do know that our prices are down and our income has stayed up. So we've got similar costs this year to what we've had in the past. But with the agri-stability program, we actually only need in this particular client a 14% drop in revenue. So if you look at some of the pricing out there with the grains, it's not going to take us that long to get there. So I think it's just important to be very mindful that this could be a year for some payments. Anything to add, Peter?
No, I just was going to say, maybe, not that we need to go back, but your agri-stability margin, and I think there's a lot of misunderstanding about the program and the understanding, but it's, especially in the beef sector, it's based on your historical margin. So despite the fact you think, well, agri-stability has not worked for me in the past, so it's not going to work for me in the future, it's building on those historical margins. And so it's as important now going forward because we're now moving into multiple years where we've had high margins. So your margins and the protection that you're going to have from the program is going to continue to build. So if 2025 is projected to be another good year and you start to have this compounding effect where, like we saw in the grain sector, where we saw basically 3 years in a row of record margins. So that means that agri-stability program is that we really have record coverage in agri-stability to be able to soften the blow on the downside.
Yeah, exactly. So we thought we would put in here, when you're doing those or you're talking to your accountant this year and putting that together, there's a couple things. I don't think we spend enough time talking about this, but in a kind of year that we're in now, how do we then maximize what we get out of the program? So there's 4 things that we would say are really key. We call them payment drivers. So what's going to drive a payment in the agri-stability program? One of those is what we call a structure change. So you want to make sure for your current farming year, you're really comparing apples to apples of previous years. This would be something, for example, where on a grain farm, perhaps you've gone up in acres this year. Well, we want to make sure that when comparing this year to the previous years, it looks at, okay, if my farm was this size for those years, what would it have been? So talking about some of those changes that are happening on the farm. Making sure in your books that you've got costs allocated where they should be. So there's only certain costs that count for agri-stability. Make sure that we've got those in the right place so that we can get the best information to get the best payment out of it. So for example, fuel. Fuel is something that can drive that margin down in 2024, which would trigger a higher payment. So we don't want to have it in with repairs or things like that. Inventory is a big one. I know last year I worked with a couple of producers that did have payments, and so we spent some time going through and making sure we've actually got the grade of your grains correct. Or if it's cattle, the weight of your cattle, the number of cattle you've got, because those things will also affect the numbers. And once you're in a payment, every dollar is 80 cents in your pocket. And then the fourth one is, we call it accrual. This is just making sure we're lining things up in the right year. So, for example, if you're pre-buying fertilizer for 2025, we want to make sure it's in 2025 and not 24. So, having all of those conversations.
I think too, again, a misconception that this information only matters in the year of your payment.
Right.
But in reality, it probably matters more in the years that you're not in a payment. So for instance, just going back and double checking that your sales quantity matches what you reported for your ending inventory from the previous year. So just making sure that information lines up again if you're talking about cattle flows, that your actual sales numbers line up to what you reported at the end of the year.
Yes, very much, because it's a margin-based reference prior year program, so the more accurate it is, the more we can take advantage of it in the year that it's going to do something. This back.
Yeah. So I just wanted to come back to looking at some of this trendline information that I showed before. So we talked a lot about kind of our projections. I don't want to push the wrong button here. Our projections here for 24 and 25, which is based on trendline yields that we see in Manitoba, predominantly for wheat and canola. But we saw some situations this year with some producers where their expected margin is significantly different. So this is an actual farm that I work with, and their yields came in for canola at 37 bushels an acre and wheat at 55. So not terrible yields, but less than what they would have expected. And so in this particular case, obviously we're looking at potentially a loss of $73 an acre in 24 and projected similar for 2025. But the advantage is if we then take that information and we overlay potentially some crop insurance or some agri-stability coverage to that, is that loss can be changed from $73 an acre loss down to about $19 or $20 an acre loss. So again, really it doesn't completely eliminate the loss, but provides a soft landing for this farm, allows them, what I would say right now is that it's this opportunity for you to get some breathing room. So maybe feeling the pressure about lower margins, feeling the pressure with higher costs, trying to make capital decisions, is that you have this opportunity to have a soft landing for your farm if you've properly implemented your risk management plan, to be able to think about some of those longer term strategies to build your resiliency in your farm on a go-forward basis. So one of the tools that we talked about agri-stability, but one of the tools that we have on the consulting side is something that's called the Ag-Risk Management Projector. And what the Ag-Risk Management Projector does is it looks at all of the different risk management programs that are out there and overlays those over your expected production, and then looks at how those programs are going to work together. Oh, we got stuck. There we go. Thank you. Magical mouse. So what you can see then is that as your expected production changes And that dark green bar is you can see that there's some risk management programs that start to come into play. So in this case, there's crop insurance that will provide some coverage, there's agri-stability, and then ultimately we're going to look at that top part, which is the most important, is the gap or the shortfall. And really, again, understanding what is the best strategy. And for some farms, it might be to try to minimize that gap, to look at all of the programs that are available and to try and make that gap as small as possible. Or it might be just to fully understand what the worst case scenario is and then use some of the other tools that are out there to help you manage, depending on your working capital, depending on kind of your debt load and what you can afford to tolerate. The other thing that it does is it allows you to run some comparisons between some different products. So you could look at something like a Global Agri Solutions or some of the private insurance and be able to compare those back and forth, whether you're looking at it, whether you're looking at crop insurance, agri-stability, and be able to put all those things together. So really providing you with kind of an infinite number of options and really honing in on what the true risk exposure is for your farm.
And I think this is a really great tool to use as you're making those decisions, but I know I've also had producers tell me that this is a really great tool they like to use in the year. So even after those decisions are made, just understanding this has happened, now where am I at?
Yeah, absolutely. I think, as we go through this season right now, everyone it's ag, we're at Ag Days, everybody's full of optimism. But as we start to see some of those weather events come into play, then you can come back to this and say, hey, let's revisit that and look at, now that I have a better understanding of where prices are, or how my production is going to come in, how that ultimately, where I'm going to kind of fit on that graph and give me a little closer to actual. So we come back to my car analogy. And looking at, again, that we can ask the same questions and we can get three significantly different answers that might work or might not work in your situation. So there's lots to talk about AI right now. So I decided that maybe we should ask AI if possibly one of these vehicles might fit for a certain category of people. So I asked Copilot, is the one that we use that's part of Microsoft. I said, what kind of car would a student drive? And this is the car that's very similar to that little red one that we had before. I then asked, what kind of car would a family, should probably a family have? And lo and behold, we got someone that's similar. And then finally, I asked what kind of vehicle a farmer might have, and it lined itself up. So if we can ask a little bit different or a little bit better questions, that maybe it gets us a little bit closer to, as it relates to our risk management planning, then it gets you a little closer to the vehicle that's going to work in your particular situation. So with that, just coming back to where we started, which is thinking about some of these high-value tasks. We talked about risk management here today. If you're feeling good about your risk management plan, you can check that off the list. If you're not, then we'd certainly be happy to talk to you about it, provide you some additional information, give you some comfort. Again, so maybe with some help from us, you can check it off, and then you can focus on some of these other areas for your farm.
I think we're getting close to time, so I don't know if we have time of 4 minutes. If there's any questions from anybody, we're happy to answer them now or after as well.
Yeah, and just remind you that you can scan the QR code as well, and you can send those in, and we'll get someone to follow up with you as well. Okay, we're going to get off easy. Thank you very much for your time.
Thanks, everybody.